but the industry is still looking for clarity on the impact of tariffs on global supply chains after the president threatened major levies on pharma while speaking at an event just yesterday. For more, BMO Managing Director Evan David Siegerman joins us now. Evan, great to have you with us.
Thank you for having me.
All of you. We're glad to have all of you. In terms of the uncertainty, we were talking about the uncertainty in the markets and how this lasts for 90 days, and we still haven't heard about what these pharma tariffs could be. So how are you advising investors? Are you still assuming that there will be tariffs coming, or are you assuming that there will be some sort of pause in the meantime?
So a few things that we're thinking about. First of all, we love the 90-day reprieve. We're very against any pharmaceutical tariffs. We think they're bad for the sector. What's really interesting is many of our major biopharma companies, so think Merck, Lilly, have a lot of supply, or they manufacture their supply in the United States, like Lilly. So they're able to weather the storm. And these are tariffs under emergency powers. So they only last the administration or if an act of Congress comes in and stops it. So a lot of these companies can't really change their supply chain so quickly. So they're going to weather it out. So I advise not doing anything, especially until we have more clarity.
In terms of a lot of the pharma companies that have made investments in Ireland, and Lilly also just reaffirmed its commitment to Ireland, are there many finished products that come from Ireland into the United States, or APIs, active ingredients that come from Ireland into the United States for finishing?
So the Ireland question is very important. So a lot of these companies domicile their IP in Ireland to save on taxes, but they also have to finish and manufacture the products and import them to the United States. So for a company like Merck or Regeneron, they do that and they import their products into the United States to pay lower taxes with the whole transfer pricing thing. A company like Lilly has invested or is committing to invest $50 billion on U.S. manufacturing. So they're committed to manufacturing for the U.S. market in the United States. So they may not have to deal with that. In terms of reshoring IP, especially for a product that's on the market, that's very expensive because Ireland may charge a capital gains tax on the value of that IP. And of course, bringing the manufacturing onshore could take 2 years.
For generic makers, I would think this is a particularly tough situation to be in, since the margins are already so thin, and a tariff could make producing generics unprofitable. Which companies do you think are most at risk in that realm? And what can everyday Americans think? How should you think about, even if you're taking a generic, how much those, granted, costs are low in general for generics, but for some people, doubling that price could be a lot.
So most of the companies that I cover really do not have huge generic businesses. They've divested them. So Pfizer, for example, divested them. But when you look at the generics business, generally, a lot of those products are made in India and in China. China, especially, that's been a hot topic of conversation today. I think that's something we're closely watching, because a lot of the API and finished product is made there. They do a lot of chemical synthesis, bringing, antibiotics, statins, other pain medications, all the generic drugs that most people are used to getting for the pharmacy for a couple of bucks. So I'm focused on that because you don't want to interrupt that supply. I appreciate the need to bring some of that onshore. However, doing that would be very challenging. And so I don't know if that's where we really want to focus our energy, given that we have a lot of innovative manufacturing here in the United States.
Evan, in the spring of 2015, Gilead made an all-time high, I think it was $120 a share. Then it became the victim of its own success and had 7 years of just horrible performance. Well, we're back there now, and despite the stock market pull-off, it's hanging around. Is Gilead still a buy here?
I would say so. We're really enthusiastic about the long-acting PrEP launch. They have this drug called lenacapavir launching in the second half of this year. I'd also focus on their durable HIV business, right? They are the king of reinventing themselves, from some of their earlier HIV medications to Biktarvy to now longer-acting treatments, allowing them to continue to be profitable and grow through an LOE cycle. I'm also focused on their cell therapy business, which would be totally exempt from any sort of tariffs, because those are super personalized medications.